Hello and welcome to the Stock Out. This is your show at FreightWaves for all things related to the CPG industry, the consumer packaged goods industry. I'm your host, Mike Baudendistel. I set aside about 26 minutes here every Monday to go through what's happening in the world of CPG news and the freight metrics that we track in Sonar that are most relevant to the CPG industry. And today I'll talk about what some of the CPG companies are saying, what some of the retailers are saying about where CPG prices go from here. There's some differing opinions about that, so I'll go through that. Also talk through some macro data I think was pretty important, as well as some news about what could happen with food stamps that I think are pretty important as far as that they could relate to CPG demand. And then I'll go through a few charts from FreightWaves Sonar. But before I do that, I would encourage anyone who's not already signed up for the FreightWaves newsletter on the Stock Out to go and do that. Just go to www.freightwaves.com/the Stock Out, or you can just go to FreightWaves, up at the top, newsletters. The Stock Out's the first thing that comes up under supply chains. Would also encourage you to go through and sign up for any other newsletters that are relevant. Some of the others that might be relevant to you would be Point of Sale, which focus on retail, and then there's one on cold chain. So I encourage you to do those as well. Also, this week is Global Supply Chain Week at FreightWaves, and so we're going to have another virtual conference that takes place starting tomorrow, Tuesday, goes through Thursday, and on Wednesday, we set aside time to speak specifically on the CPG industry. Some of the speakers there include Ben Ritchie. He does the logistics for Black Rifle Coffee, Tom Madrecki, who's the supply chain guy at the Consumer Brands Association, Herman Hackstein, who I interviewed. He's the president of the Private Railcar Food and Beverage Association. So anyone that ships consumer packaged goods via the railroad is going to want to be interested in that session. And then Peter Friedman, he's the executive director of the Agriculture Transportation Coalition. It'll be interesting to see if he says anything about rail service as well. A lot of those shippers that rely on rail to move agriculture products have had all kinds of service issues. Some of that directly relates to CPG. So would encourage you to view those things in the coming weeks and reach out to those contacts as you see fit. So with that, I'll get into the content today. Topic number one, there really is this lack of consensus on the CPG retail price outlook. So really one of the big topics right now in CPG is where do the prices on the shelves go from here? A lot of these CPG prices are 15% higher than they were at this time last year. And those prices last year were about 10%, in some cases 8%, but in any event, higher than they were the previous year. So you go look at what CPG prices now versus 2 years ago. A lot of those are 20 to 25% higher than they were. And when they survey consumers as far as how much they think that their grocery prices are higher than they were, a couple of years ago, the consumers almost always overestimate the change in the prices versus how much they actually change. So it feels worse to consumers than it really is. And this retail price issue is coming to the forefront, not just because consumers are getting, tapped out. We're seeing savings rates go down, consumer credit cards, going up. But, you look at a lot of this commodity price, and the commodities are just way off their highs. You have a chart from just of wheat futures for September delivery. And this is the type of chart where you look at that and think, well, okay, well, our grocery prices have to come down pretty quickly, right? I mean, considering that wheat futures are back to where they were, pre-pandemic levels, but some of the CPG companies, don't view it that way. So I have a list of companies here that are not expecting further price increases. So last week, Kraft Heinz said it would not have any further price increases, at least not in the near term. Pepsi said something similar. Pepsi said that they had most of their price increases for the year already in place. Now they did take a lot of price increases in the past in the past year, so that may have something to do with that. And then there was this really sort of interesting quote from the CEO of Edgewell Personal Care, it's a company that owns Schick Razor, among other things. And he said it's going to be very difficult to pass on further price increases to the retailers, at least from his perspective, and that's sort of the personal care grooming segments. He said that Walmart is telling their suppliers that the CPGs would have to have very good reasons to increase prices from here after going through multiple rounds of price increases. Heard something similar from Whole Foods. Whole Foods reportedly hosted a virtual conference, and they told their suppliers that they're expecting price cuts. So there's 4 different companies that say, well, most of these price cuts are kind of behind us. Maybe they go flat from here. There are some on the opposite side, so I can go through those. Nestle last week, so this is the biggest packaged food company. They say that their net sales is going to grow 6 to 8% this year, which will be pricing led, which I interpret to mean sort of flattish volume, with most of that 6 to 8% being price, and maybe that's similar to what they just had in 2022, which is 8%. And Nestle also said that they have some catching up to do as far as recovering their costs in price. So they think the prices go up more. Unilever said that we're past peak inflation. This is from the outgoing CEO. So past peak inflation, but not past peak prices. So that it sounds to me like where prices are still rising at a slower rate, getting into the second derivatives. Heard something similar from their most comparable company, which is Procter & Gamble. They think the prices are going to continue to rise. Also heard Treehouse Foods, which reported in the last week or so. That company said that really what you're seeing, the commodities that you're seeing in the traded commodities, yes, those have come down, like that chart I showed earlier on wheat, but they're non-tradable expenses, things like labor, packaging, labeling, a lot of the other things that go into the costs of packaged foods. Those have come. Those are still rising, and so it's just the traded commodities are coming down. The non-traded commodities still going up. Also heard Mondelez. They say their costs are going to be higher by double digits in 2023. They said part of that's related to their own company-specific hedges that are rolling off that they've had previously benefited from. But also, they say that they're still having higher expenses for a lot of the things that they buy that they need. So also heard that from Coca-Cola. They say prices are still rising. So most of the CPG companies suggest that there's still further to go on price increases, and maybe there are additional rounds. And it does seem to lend itself to a more contentious relationship between the CPG companies and the retailers. The retailers want to hold the line on pricing from here. A lot of those retailers are concerned about market share losses to a lot of the discounters. The retail chains that are the fastest growing right now would include Aldi, which is almost all private label, and a lot of the dollar stores, actually, like Dollar General, adding a lot of locations. They're actually adding a lot of space that's dedicated to refrigerated and food, and sort of the traditional retailers concerned about holding on to some of that the market share that are priced a little bit higher. So there's going to be a lot of back and forth. There was this interesting sort of back and forth with the CEO of Tesco. Now, Tesco is a UK retailer, so I wasn't familiar with this one, but supposedly they said that their company had a falling out with certain suppliers over price. I guess the CEO was quoted in an interview where he said that the suppliers were gouging consumers on the price, and really blamed the CPG companies for the higher prices on shelves that consumers are seeing. Of course, the CPG companies didn't agree with that, and that one's. I don't know that there's going to be a lot of cases with the major retailers in the U.S. that come to that. Maybe cooler heads will prevail, but in any case, you may see things like retailers ordering fewer, smaller quantities of certain goods. Maybe they'll do something with promotions. Maybe they'll do something with product placement on shelves. But clearly, I think the relationship between retailer and CPG companies may be a little bit strained. So I think the where the prices go from here ultimately is going to be depending on how much elasticity some of these products are seeing. Some are still not seeing a lot of elasticity. Some of these companies say they're raising prices double digits, and they're only seeing volumes go down 2%, which most CPG companies will take. And then just the relative force between the CPG company and the retailer. Walmart from here, if that consumer products company is to be believed, maybe they hold the price, hold the line on price more so than some of these other retailers. Moving on to topic number 2, the producer price index, the PPI, exceeds expectations in January. This is one thing that, when this was reported, the stock market was down last week, sort of showed that maybe inflation is not easing as quickly as some would like it to ease, and have a chart on this. And this is what this basically shows is that the consumer price index, the CPI, which is in white, had risen at a certain pace that peaked up at 9% or so earlier or last year. But during most of this time during the pandemic, that green line, which is the producer price index, rose faster than. So the PPI rose faster than the CPI. That caused margin pressure for a lot of the CPG companies that fell into that category. I mean, a lot of those companies that have seen a lot of pressure on their margins as well, and that's something I think a lot of the CPG companies are going to try to get back. But getting back to that PPI, it increased 0.7% in January from the prior month. That's compared to a 0.2% drop in December. Supplier prices rose 6% in January from a year earlier. That's less than the 6.5% year over year they rose in December, and below the 11.7% peak in March of 2022. But in any event, that I think most people were expecting something closer to what they saw in December, 2% or 0.2% month over month, instead of the 0.7% month over month. So I have another chart here on the producer price index from the Bureau of Labor Statistics, if we could get that up, and really this shows for food manufacturing. This is for food manufacturing specifically, and it shows a few things here. It shows just how well behaved the food industry's prices were, that their costs were from about 2013 really up until the pandemic started, where there just was not a lot of inflation there, and in return they were able to see margins that improved. And then all of a sudden 2021 inflation starts to hit for a number of reasons, commodities as well as supply chain issues, and it's had kind of a step function up from 2020 into 2021, and then again from 2021, the Ukraine war starts into 2022. So you've had these sort of two annual hits in a row, and if you just look at the food PPI, it increased 0.5% in January, and it had declined 0.8% in December. So the food PPI, it really was a whipsaw there, and that food PPI up 9.1% year over year in January. And so the conclusion is that the government data, at least, seems to support the CPG's contention. Most of those CPGs are saying, my costs are still rising, even if the traded commodities are down. The PPI data, specifically for food, seems to bear that out. So I think probably we'll see retail prices continue to rise. I think the CPG companies probably have to do that in order to get their margins back to targeted levels. So not great news for the consumers. I'll move on to topic number 3 here, which is changes to SNAP could hit packaged food demand. So SNAP, basically the food stamps. What was interesting is that in 2022, the SNAP benefits made up. This is a couple of articles I read over the weekend from the Wall Street Journal. There's in other places too related to food, but this could have a pretty big impact on the CPG companies because a lot of the extended or enhanced SNAP benefits that went into place during COVID are going to start to run off in March for about 38 states. Some states they've already started to come off, but kind of some interesting stats I'll run through that were in the media. So in 2022, SNAP benefits, if you include the COVID era emergency allotments, made up 12.3% of total at-home food and beverage. So 12.3%, and that's up from 7.1% in 2019. And so this is a chart, okay, a little bit out of date, but you get the idea where, that dark green bars represent the emergency allotments that went into effect starting in March of 2020, went fully into effect, April 2020, and that was a big sort of step up in, the SNAP benefits and also the SNAP participation. So they loosened all of those things, and clearly a lot of those funds were spent on a lot of the national CPG brands tended to gain market share during that time. Large part of that is because their supply chains were functional and those products were on shelves. But some stats here I think are kind of interesting is in March, SNAP participants in about 35 states will lose at least $95 a month, or some $3 billion. So a three-person household that receives these benefits will go from $759 a month to $592 a month. And some of the states that decided to roll this back early, they did see those states underperform in terms of some of these food products, according to certain analyst reports. There are some states that'll be an exception. New Jersey is going to make up for it with state benefits, but that's going to be the exception rather than the rule. And there is going to be a cost of living adjustment where just the normal SNAP benefits step up for inflation, but sort of on a net basis, the SNAP funds available are expected to decline 7%. So I think that's something that could have a meaningful impact on a lot of the national CPG brands. Topic number 4 here, I'll get into the freight data. Always like to spend at least a few minutes on FreightWaves Sonar and what we can learn from that after going through the CPG news. So I want to bring up this first chart, which is the van and reefer outbound tender rejection index. And so dry van tender rejection index is in white, reefer is in green, and this shows, well, those are both really at low levels. Van at 3%, reefer at 4%. The only time it was any worse than that was right as everything was shut down in March of 2020, and shippers weren't getting things shipped, and so it was maybe even easier to get something moved there and accepted there. But without a lot of other exceptions, this is about on a relative basis about the loosest capacity has seen. Donnie Gilbert walked through his reefer story this morning on FreightWaves Now. I'd encourage you to go back and listen to this. But if you're a shipper and you see those tender rejection rates in that low single digits, you really have to hold carriers accountable to accepting 90+% of your loads. Those do vary by lane, and you can go into FreightWaves Sonar and look at exactly what those tender rejection rates are per lane or outbound of inbound of certain locations. But really, the shipper should be holding carriers to a high level right now. As far as how that's translating to contract rates, I want to bring up the van contract rate chart. And so 2023 year to date is in white, and this shows that van contract rates from a company that processes transactions down by 8.2% year over year. And you see 2020 was in orange, and it was a double-digit rate increase from there to 2021 in blue, and then again from 2021 to 2022 in green. So you saw 2 years of consecutive double-digit price increases, and 2020 and 2021, you saw those contract rates rise throughout the year as contracts were rebid. 2022, it was the opposite, where the rates were pretty much flat up until about August, and those started to come down. Now they're down 8.2% year over year. Would think that spread between this year and last widens at least through the first half of the year based on where spot rates are, and spot rates are still well below dry van contract rates. I want to bring up another chart that I think is interesting. It's the van contract rates, and I compare those to the reefer contract rates. And so the van contract rates are in white, and the reefer contract rates are in blue. So you want to go back to the last time we had a quote unquote normal freight market, which is before pandemic. Let's call that 2019, which 2019 was loose, but aside from that, more normal than what we've had during the COVID timeframe. So during that timeframe, reefer rates, as you can see on the chart, higher than dry van contracts by, let's say, 20 cents a mile, 25 cents a mile. And since the middle of 2020, since so much of that demand was concentrated in the dry space, that's just demand that's more volatile. The dry van rates really went crazy. It went from about $2 a mile before fuel surcharge. This is just line haul rates I'm speaking of here. Went all the way up to $3 on average. They've since retreated to $2.57. The reefer rates went down to $1.75, but then went up to almost let's call it $2.70, and now are $2.45. So we're still showing van rates 12 cents above reefer rates. Those are both contract rates. Those both exclude fuel. So keep that in mind. But maybe at some point there needs to be those lines need to cross again, and reefer needs to again be higher than dry van in order for when the market fully normalizes. And my interpretation of that is maybe that the dry van rates have further to fall than the refrigerated rates. But we'll see. We'll see on that. I also want to bring up a chart on intermodal contract rates, comparing those to dry van rates. So this is one where the intermodal, both of these contract rates exclude fuel, which is on this next chart I'll include them. But just main point here is that the dry van rates do tend to be more volatile than the intermodal contracts. Intermodal contracts are in white. The van contracts are in blue. And from here, you can look at sort of an intermodal savings chart if you want to go to the next chart, which is the intermodal contract savings. And so this is from the same data supplier, so the company that processes transactions. The intermodal contract savings for all lengths of haul is in white. And what that shows is when you include fuel surcharges into intermodal rates and also include them into dry van rates, and you just limit the data series to the same 5-digit origin destination pairs, shipping goods on the same week, and sort of to eliminate all those other variables about having too long of drays or too short of drays on either side. The spread between dry van and intermodal is right at about 10%, which 10% is at the low end of the historical range. I mean, you tend to think of intermodal rates all in, including fuel, tend to be let's call it 10 to 15% below dry van. Our data shows it's more like 10 to 20% below dry van if you just look at the same 5-digit origin destination pairs. And so it does show that that's kind of sort of the right part of the low end of the range. So to get sort of the middle part of the range, I think the dry van contract rates have further to fall. And that's really been dramatic if you want to put that chart back up with what's happened with the long haul savings rate. So that green line is limiting the lengths of haul to 1,200 miles or longer. So that's going to include the LA to Chicago, LA to Dallas, LA to Atlanta, et cetera. And then when you look at that, there were times where we found it was high as 30%, and now it's down to 13%. So that's come down a long way as well. I think part of that is the weakness in the dry van contract market outside of LA, where the tender rejection rates in LA have been very low for an extended period of time. That's important because it just shows that the dry van market is very competitive in some lanes that are traditionally purely intermodal lanes. And you think about a lane like LA to Dallas, 1,500 miles, intermodal tends to be, intermodal. That would be an intermodal lane. But I think a lot of carriers are willing to take that, gets them into a fairly good market in Dallas, gets them out of a weaker market in LA. So I think that's one of the changes that we're seeing, in the marketplace. And I think that's, a data set that's relevant for shippers that use both modes, both dry van and intermodal. And there are some shippers, including some CPG companies, that will share with us the rates they're paying in dry van and intermodal. We're going in and we're comparing the rates that they're paying in the marketplace with other rates that we're seeing, showing them lane by lane which lanes they're paying too much in, which lanes maybe they're below the market in, which it can also present a problem if they're not getting coverage and carriers are going to other shippers when things get a little bit tight. But all things considered, I think maybe the contract rates across some of these modes has held up better than I would have expected in light of the fact that the tender rejection rates have been so low, and there is looseness in capacity. And I think a lot of that is related to the big shippers want to continue to be the preferred shippers. And so I think the idea is to not screw over the carrier too badly when things are tight, because you're going to want to have that capacity available when things recover. And it's only a matter of time before inventories get drawn down too far and need to be restocked. We don't know, when exactly that is. That's always hard to call the timing, but at some point, inventories will need to be restocked. Transportation capacity will get tight again, and those companies, I think, will be happy to have those carriers as partners. So with that, that's really what I wanted to cover today. Encourage you again to go to this www.freightwaves.com /the stock out, sign up for that newsletter, and hope everyone has a great day.